Every era believes in its own money. Every system assumes its stability is absolute. And every time, history systematically punishes that confidence. When empires collapse, it is not only borders that dissolve, but meaning itself. Money is among the first things to break down. Because money is not a material reality as much as it is a collective agreement. When that agreement fractures, what remains are worthless papers, useless numbers, and unfulfilled promises. For this reason, collapse is not an exception, it is continuity. The real issue is not whether systems will break. The real issue is where you stand when they do. Modern individuals feel secure by looking at digital balances. Yet those balances are not assets, they are promises. The money in your bank is not something you possess. It is a claim you hope will be repaid. This distinction is invisible in stable times. In moments of crisis, it becomes critical. History demonstrates this reality repeatedly. The Byzantine Empire owed its longevity not only to military or political strength, but to monetary trust. The solidus served as a silent guarantee of trade for centuries. Yet instead of preserving that trust, the state chose to erode it. The purity of gold was reduced. Coins were thinned. Value appeared stable, but was hollowed out from within. The outcome was inevitable. Trust broke. Trade weakened. Money ceased to function as a medium of exchange and became an object of suspicion. This was not unique to Byzantium. The debasement of currency in the Roman Empire was an earlier version of the same process. The silver denarius gradually became an empty symbol. The empire eroded its own foundation by diluting its currency. The tendency of states to debase money is not an anomaly, it is structural. However, collapse does not always originate from within. Sometimes external shocks accelerate the breakdown. The Black Death shattered Europe's demographic structure. A large portion of the population disappeared. This destruction inverted economic balances. Labor became scarce and therefore valuable. Land and property became abundant. Assets that were once inaccessible became attainable. This was less a collapse than a redistribution. A similar dynamic was observed in the modern world during COVID-19. Supply chains broke down, central banks expanded aggressively, and asset prices inflated. Those with access to liquidity accumulated valuable assets. Those without it were left outside the system. Crises do not create inequality. They accelerate it. The fragility of financial institutions represents another dimension of this cycle. In medieval Florence, the Bardi and Peruzzi banks were among Europe's most powerful financial actors. Yet when Edward III defaulted on his debts, these massive institutions collapsed within days. Power, scale, and reputation provided no protection against systemic risk. The same fragility appeared in modern times with the collapse of Lehman Brothers in 2008. The phrase "too big to fail" is a recurring illusion, disproven in every crisis. War periods expose the true nature of money in its most stripped form. During the American Civil War, both the Union and the Confederacy financed themselves by printing money. Each new banknote eroded the value of the existing supply. In the South, inflation reached uncontrollable levels. Money circulated, but it no longer functioned. Value remained not in paper, but in tangible assets. A similar process occurred during the French Revolution with the assignat. Paper currency, theoretically backed by property, was destroyed by excessive issuance. The market did not accept the value defined by the state, but the value it recognized itself. Money is always the product of collective agreement. The state cannot impose that agreement, it can only maintain it. Global financial crises replicate this dynamic on a larger scale. The 1997 Asian financial crisis revealed the fragility of borrowing in foreign currency. When exchange rates collapsed, debts multiplied, local economies contracted. Wealth was transferred from local populations to global actors. A more recent example, the Lebanese financial crisis, demonstrated how quickly trust in the banking system can disappear. Deposits were frozen, the currency collapsed, individuals lost access to their own assets. These examples belong to different geographies, yet all point to the same structural truth. Money is fragile. Institutions are temporary. Trust, once broken, is not easily restored. For this reason, protection cannot rely on a single instrument. History suggests a diversified approach. Tangible assets, liquidity, low or no debt, geographic and financial distribution, and most importantly, productive capacity. Because in times of crisis, the most valuable thing is not what you own, but what you can produce. A baker's ability to produce bread is more valuable than an investment account. A craftsman's skill to repair is more functional than a bank balance. A farmer's production retains meaning outside the monetary system. When money collapses, the economy does not stop. It simply changes form. At this point, collapse produces two outcomes: destruction for the unprepared, repositioning for the prepared. The social transformation in Europe after the Black Death, where peasants became landowners, is an early example of this repositioning. Likewise, the redistribution of assets after 2008 is its modern counterpart. Every crisis is an invisible transfer mechanism, from trust to doubt, from passivity to production, from gain to debt. Ultimately, the question does not change. Will the system built by others collapse? Yes, inevitably. History is full of such examples. But the real question is this: when collapse arrives, what will remain in your hands?